Welcome to the Roundup, covering what's important to accountants and advisors across the month of February. Inside this month, the implications of the decision impact statement in the Woods case. We'll also take a look at the ATO's final position on electric cars. But first up, let's talk about ATO debt. Matthew, the ATO has changed its position. Can you tell us what's going on here?
Yes, they have. And it's probably worthwhile giving some context on this area first. Now, late last year, the ATO sent out a bunch of letters to clients and practitioners about tax debts that have been placed on hold. And to be fair, the ATO did actually get a bit of a nudge, a bit of a poke from the Australian National Audit Office about not doing enough with these liabilities. So what the ATO did was they sent out a bunch of letters, and these letters basically said, look, you've got some debts on hold, and debts on hold are really liabilities, tax liabilities that the ATO have deemed uneconomical to pursue. They're still real tax liabilities. It's just that the ATO won't actively seek to go out and collect on them. They're not going to send in the debt collectors, but if the client is entitled to a refund, the ATO are certainly going to offset those refunds against that outstanding tax liability. Now, that caused a bit of an angst because some practitioners and clients weren't aware of these tax liabilities in the first place. Some of these debts are quite old, and these debts on hold, they don't exactly display very prominently on someone's statement of account. So you had some practitioners working quite hard to try and reconcile and check that these debts were sourced from something real, sourced from something substantive. It also didn't help that some of these debts were quite small. So the ATO got a bit of feedback around how it was trying to approach this area. And to be fair, the ATO's now changed their tact a little bit.
Now that we understand the context, what is it that we need to understand about this in terms of the ATO's approach? And more specifically, what should we be telling our clients about this area?
The approach is going to depend on when those debts were put on hold. If the client had debts put on hold on or after 2017, then the ATO's approach isn't changing. If the client is expecting a refund, then the ATO is probably going to offset those refunds against those outstanding tax liabilities, even if they've been put on hold. And clients should be made aware of that. You certainly don't want clients expecting a certain refund amount, but then ultimately getting something lower. On the other hand, if you've got clients that had debts placed on hold before 2017, then the ATO's approach is changing, and this is where it gets a bit more interesting. The ATO are now saying that they're going to pause collection, and they're also going to pause offsetting refunds against those older debts on hold, at least until the ATO, in their words, figures out a pragmatic solution. Now, but to put that in context, there are media reports out there suggesting that the total debts on hold prior to 2017 number somewhere around $15 billion. That's a lot of money that the ATO's got to figure out what to do with. And in a way, it might even be out of their control, because if they want the debt written off, they might need to write to the finance minister to see if they're willing to do that. And I guess there's a question, and I guess a larger question, as to whether that's appropriate. But that's a question for government. And for us, if we do have clients that have debts that have been placed on hold prior to 2017, well, they've earned a bit of a reprieve, at least until the government figures out what the permanent fix is.
The ATO has released a decision impact statement on the Wood case that has some very interesting implications. Michael, what happened in the Wood case, and what are the principles here?
Yeah, so the Wood case was actually handed down by, a decision was handed down by the Federal Court mid last year. We've had the ATO release a decision impact statement, which kind of sets out a bit of a summary of what happened and some of the principles that come out of that case. Let's just quickly run through what the case dealt with, because it's a slightly complicated set of facts. Basically, the taxpayer was employed by their own private company, and that company was engaged by a third party under a consultancy arrangement. And so the taxpayer's company was providing services to this other party. The taxpayer was personally involved in the provision of those services. Now, that arrangement lasted for quite some time, a number of years, but it did come to an end around 2011. After that point in time, the other party basically started legal action against the taxpayer. They were alleging that the taxpayer had been involved in unauthorised transactions during the course of that arrangement and were seeking effectively damages relating to that. And so the taxpayer undertook to kind of defend those charges, and that process carried on for quite some time. Now, in the midst of all that, the taxpayer also threatened to take defamation action against the other party. They believe that a representative of the other party had basically tarnished their good name, particularly with their new employer. And so we kind of had things going both ways. We had the other party taking action against the taxpayer relating to this kind of consultancy arrangement and potentially unauthorised transactions, but we had the taxpayer also arguing that their good name had been tarnished, their reputation had been tarnished. Now, this matter was eventually settled. So the taxpayer entered into a deed of settlement, basically agreeing to pay $200,000 to the other party to bring that matter to a close. So didn't admit liability or guilt, but just agreed to pay a sum of money to make the matter go away. Around the same time, the other party also agreed to pay a sum of money to the taxpayer in relation to the threatened defamation action. So the taxpayer agreed to pay $200,000 to the other party. The other party agreed to pay $180,000 to the taxpayer. They then agreed to set off those two amounts so that the net effect was the taxpayer paid $20,000 only to the other party. Now, the issue that arose from a tax point of view was that the taxpayer tried to claim a deduction for the full $200,000 amount that they had agreed to pay to the other party. The ATO didn't like that. The ATO believed that this was not something that qualified for a tax deduction, and so initially the matter ended up before the AAT. The AAT initially found for the taxpayer. The ATO appealed, and we ended up before the federal court. Now, the short answer to all of this is the federal court found for the taxpayer. The taxpayer was allowed to claim a deduction. And there were two key things that the federal court looked at. When we're looking at whether a deduction is available under the general deduction provisions in Section 8.1, we look at the positive limbs. So we look at whether there is a sufficient connection with gaining or producing assessable income. We then look at the negative limbs. Is this an expense that's capital or private in nature? If so, we don't get the deduction. When it comes to the positive limbs in this case, the question was around timing. So at the time the settlement payment was made, there had been quite a period of time that had elapsed since the taxpayer had been involved in the relevant income earning activity. So the ATO was saying basically that there was no longer a sufficient connection with those income producing activities. This was not an amount that was incurred in gaining or producing the taxpayer's assessable income. Well, the federal court disagreed with that and said, despite the fact that the consultancy arrangement had ended and the fact that the taxpayer was no longer employed by their own company, this was still something that related closely enough to their income producing activities. This matter arose from something that occurred in the course of their income producing activities. There was still a very strong connection between the amount they've paid now and the production of their assessable income. So the court said that despite the time period that had elapsed, this was still a cost that was incurred in gaining or producing assessable income. So that's the positive limbs. When it comes to the negative limbs, is this a capital payment? Well, the ATO argued that the taxpayer really paid this amount to protect their reputation. And the ATO was pointing to this defamation allegation and saying that really the taxpayer was trying to kind of wrap up this matter so that their reputation in the finance industry would basically be protected. Well, the federal court said that that's not quite accurate. That's not really what was happening here. What was happening here was we had two separate things going on. We had some action being taken against the taxpayer, and they were paying the $200,000 to bring that action to an end, to bring that matter to a close and to be able to get on with things so that they wouldn't have to then pay a significantly larger amount. The defamation action relating to reputation was actually a separate matter, and a separate deed of release had been entered into with respect to that matter. The taxpayer was actually receiving an amount in respect of that matter. So the federal court said effectively that the amount paid by the taxpayer did not relate to basically reputation. This was not something that was to provide them with an enduring benefit in terms of protecting their reputation and goodwill effectively. These were two separate things, even though the parties had agreed to set off the two payments, just in terms of cash flow perspective. So in this case, the taxpayer was allowed to claim the deduction. There was a strong enough connection with their former income-producing activities, and this was not a payment that was made to protect reputation. This was something different. They were two separate matters, and we could look at them separately.
Are there practical scenarios where the principles of this case might be relevant?
Yeah, so I was reading through this ATO decision impact statement and the case itself. There's a couple of scenarios that really came to mind, the sort of things that we actually get asked about quite a lot. And it's really around that issue of incurring expenses after your income-producing activity has really come to an end. And I can think of two quite specific examples that come up a reasonable amount in practice. One of them is for maybe clients who've held rental properties and they've sold the rental property, but they've made a loss on sale and the proceeds just aren't sufficient to cover the outstanding loan balance. And so they are potentially stuck with an ongoing interest expense that might continue for some time. And so that is a situation where we have some ongoing expenses that relate to an income-producing activity that has well and truly finished. And fortunately, there is some guidance from the ATO in that area which suggests that if certain conditions are met, we can still claim deductions for those ongoing costs. Best reference point for that one is a tax ruling, TR 2004/4. It looks at two scenarios. One, where we incur expenses before an income-producing activity has started, think Steele's case, but also the opposite, where expenses are incurred after that income-producing activity has ended. And very common example of that is the rental property sold at a loss, still have ongoing interest expenses. Now, the key thing with scenarios like that, often in practice, is whether the client has the resources, the ability to pay down that loan and basically rid themselves of that recurring expense. If so, but they've just chosen to keep the loan on foot, maybe so they can keep claiming those deductions, the ATO often won't look at that very favourably. And so in situations like that, often we would be saying to clients that, the ATO would want to see you paying down that loan as you can. So as financial resources are available, you're actually paying that loan down as soon as possible in order to try and protect those ongoing deductions. So that's one example that comes to mind. The other one that we see a little bit is where maybe clients have been carrying on a business and they've either sold or ceased carrying on the business, but there are some expenses that continue to carry on. And a common example of that is run-off insurance coverage. So particularly for professional practices where there is a requirement or a desire to provide protection in the form of insurance after that business has ceased or been sold, there may well be insurance premiums being incurred for a period of time, a number of years after the business is sold or ceased. We've seen a number of examples where people have asked the ATO that question in the form of private rulings and where the ATO has tended to say that there is still a strong connection with those previous income earning activities, and so those premiums can potentially be deducted. Obviously depends on the scenario. The thing to watch out for there is sometimes people will pay a large lump sum premium, which will provide them with coverage over a number of years. In that case, don't forget the prepayment rules, because you may well need to spread that deduction out over a number of years. So a couple of things that come to mind, reasonably common scenarios where we do find that we might have an income-producing activity that comes to an end, but some expenses incurred potentially some years later, and they can potentially still be deductible. Clearly something we need to look at carefully, but there is some precedent to show that these things can sometimes be deductible if the conditions are right.
Coming up to the end of the FBT year, we're getting a lot of questions on Knowledge Shop's help desk about electric cars. The ATO have now finalised their position on home charging expenses. Matthew, what do we need to know?
One of the compliance challenges with electric vehicles is that it's fairly difficult to work out how much it costs in terms of electricity to charge an electric vehicle at home. And the specific problem is that you'll get your electricity bill for a period and it gives you a total. It doesn't exactly break down how much goes to lighting, how much goes to heating, and certainly not how much goes to charging that electric vehicle. And if you've got an individual client that's gone out and bought an electric vehicle for work, and they're using the logbook method and not the cents per kilometre method, then they're going to need to work out their home charging costs to determine their annual car expense deduction. if you've got clients that are employers and they're providing their employees with electric cars, then you need to work out the employees' home charging costs if you're trying to work out the taxable value using the operating cost method, or if you're trying to include those employee charging costs as a recipient contribution. Now, one of the questions we often get is whether the fact that the vehicle might be FBT exempt under the electric car exemption changes any of this. And it really doesn't. That's because even though that FBT electric car exemption might apply, you still need to calculate the taxable value of that car benefit as if the exemption wasn't available. That's because even though the employee isn't actually taxed on this, that notional taxable value gets included in the employee's reportable fringe benefit amount. Now, the ATO acknowledges that this is a very hard area. It's very difficult to calculate how much it costs in terms of electricity to charge an electric vehicle. So they've finalised this practical compliance guide with a shortcut rate. And it basically says that if your clients meet some basic conditions and they've met some record-keeping requirements, then they can use this shortcut rate to help work this out. And that shortcut rate is 4.2 cents per kilometre. Look, it's completely optional. You don't have to use it if you don't want to. And you can't actually use it if the vehicle is a plug-in hybrid vehicle. But it's certainly there to make our lives easier. And I suspect many practitioners will be referring to this practical compliance guide sooner rather than later as we move to prepare tax returns for clients that have bought electric vehicles, and especially as we move towards the end of the FBT year, as we prepare FBT returns and reportable fringe benefit amounts.
And for Knowledge Shop members, you can find the FBT work papers coming up to the end of the financial year on the knowledge base right now. Just jump in and download what you need. If your firm is not a member of Knowledge Shop as yet, we'd love to show you what a difference Knowledge Shop membership can make, whether you're a financial advisor, whether you're an accountant. We help thousands of professionals across the country every single day. Just give the team a call or jump onto the website and book in a time to see what a difference we can make. We'll look forward to speaking to you soon.